Good morning, everyone. My name is Mabatho Seeiso, and I want to welcome you to our session this morning. I've been in the financial services industry for the past 22 years, and I've come to a point in my life where I really have a deep desire to share my knowledge, my experience in investments, and also to share the many lessons that I've learned as an expert on pension funds to empower investors. These sessions are really, for me, the intention and the goal behind this sort of engagement is one, to create what I defined as street smart investor. And I think we all have a definition of what a street smart investor is. For me, it's somebody who is informed, knowledgeable, and therefore can engage with financial services products in a meaningful way and make decisions that are informed. And also, if they need to push back from providers or what we say to them, that they can push back on the industry, because actually when they do that, they make us as an industry better. So for me, this is about empowering people with information so they can make informed decisions on investments, but also on their pension funds. Secondly, the desire through these sessions that I'm holding is in some ways to make the industry better by ensuring that as an industry, we're consistent in integrating, treating customers fairly in the way we do things. One, because it leads to better outcomes for our members. And I think if members are happy, ultimately from a sustainability point of view as a industry, it works for us. But I want to remind people who are listening today as well, so they know treating customers fairly is a regulatory requirement that we're all supposed to be adhering to. So those are the two goals I have in the sessions that we are holding. Today, we start with the very first one. It's one of many. There'll be many to come to empower, and so that we can have meaningful, engaging, challenging topics that hopefully by the end of it leaves you well informed about many different aspects on investments and in pension funds. But our focus today is to talk about money market funds. Why money market funds as an investment vehicle, but most importantly, so that you people listening in and everybody, all investors, understand why fees matter in these investments. Why money markets and why fees matter. Now, to unpack this whole session around money markets, I have two guests with me. I have Lindhiem. Mark, I've known you since you were at Alexander Forbes as a consultant, and you're now at Tier Plus. And I'm happy to know that you guys do benchmarking always in the institutional space, but I think it's your expertise that will help us today. I also have Moahloli with me, a co-founder of Miller Risk Solutions. I've also known you as an asset consultant in the industry for a very long time. So I'm looking forward to an engaging session that hopefully will leave people informed. And let's unpack this. It's not as simple as I thought it was. But,
Yep.
But let's start at the very beginning, because I think it's important to contextualize and say to people exactly what are we talking about. When we talk about money markets, I'm going to start with you, Mark. When we talk about money markets, what are we talking about? How is that different from cash in the bank or a savings account that I have?
Yeah, Mabatho, this industry is filled with jargon.
Yeah.
So money market is a catch-all phrase for all type of investments that are different ranges of deposits, anything that would be classified as money market. Typically investments that are invested in a bank. But I think the main distinction between money market and what most listeners will know as a fixed deposit or money in the bank is that the money market funds are managed by professional investors. They are funds, and the goal of the professional investors, investment fund managers, is to effectively perform or provide the best investment interest rates returns in that particular fund. And they're typically short-term investments, but the main distinction there is that they're actively managed in the money market space.
Okay. But I think maybe just so people will say, how do we make money from a money market fund? We talked about interest rates, but just the underlying instrument. So people understand it's dead, right?
Mm-hmm.
Somebody issues debt, short-term debt. Do you want to just unpack that a little bit?
I think just sort of to also add on to what Mark was saying, generally money market funds are put together in the structure of sort of some short-term investments. So there is an expectation that there is some sort of return, and that's where the understanding of interest rates playing a role in loaning out of the money. So that brings it to your money market funds, so that the investor typically has a sum of money, not sure what to do with it in the short term, or maybe has plans over it for within the next 12, 24 months. They don't want to really put the money in the mattress, but they want to sort of, as this money is patiently waiting, what sort of interest can it earn? And interest is really the additional money you get for putting money away. And that is your sort of first step into the savings and earnings models that we see. So what then do the fund managers do? As Mark was mentioning, they are managed by investment professionals who go out there and look for credit where they can loan these funds to either banks, either corporates, either government over a short period of time, and try to make this return, this interest rate that they have promised you to pay you over a specified time. So that is what the sort of background or back end would be happening in the money market funds.
Okay. I think that's very important, because people don't understand, how do money markets make money, or just any investment. So you're borrowing out money to corporates, and you're getting money back. But I think the next thing that we spoke about is so if I'm an investor, what sort of money would I put in a money market fund? And that's what you've started touching on, Mmathabo. I think it's important. So if I'm sitting there wanting to make a decision for myself and say, okay, I have a varied investment options around me, but I want to put money in a money market fund, what sort of money would I be putting in a money market fund? I know what I'd put in a money market fund, but I want to hear from you. Yeah.
So, I mean, there are no hard and fast rules, but I think there's a couple of criteria that you can use. If it's money that's going to be sustainable, which is you just want some money available for whenever. You don't know when you may need to use it, but you may need to use it on short notice. A money market fund is a great vehicle because it's an ongoing vehicle. Contrast that to a deposit in a bank, a 32-day deposit. These type of bank savings accounts tend to mature, and then you get the money paid back, and then you have to reinvest it. Whereas with the money market fund, you invest in the fund and you can stay in that fund for as long as you want. The accessibility is the key thing. We call it liquidity in the industry, but accessibility is that you can get your money at any time. And there is an interest rate paid on the money, and hopefully a competitive interest rate, because it's a competitive industry and there's a lot of money market funds out there. And that's another topic as to how many providers and how do you choose.
Yeah, exactly.
But they're all trying to get the best interest rates in that sphere of the market, which is money market low risk.
Okay. So I know what sort of money I've put in my money market fund. I know I'm a provisional taxpayer, so I've got my savings there, so that when I need my tax liability arises, I can pay that. But people pay what you want to save for a mortgage or down payment on a car or a house, school fees.
Yep.
But I think, or emergency funds. Other people put emergency funds in there. But as you say, there's a term limit, perhaps, in terms of liquidity, or what sort of money you need to be liquid. Mmathabo, do you have anything else to it?
So what I probably would add to it is that term is quite important, because also when you do put money away in a money market fund for extended period of time, you're not really getting much of a capital appreciation there, right? Because of that accessibility factor.
And I think that's what we'll come and emphasize on. I think people need to understand what are the outcomes you're getting from a money market
fund.
Yeah.
Correct. So when you sit and sort of do your planning and say, I've got excess cash of so much, what is the end goal with that cash? By determining the end goal of that cash, then the accessibility gives you what sort of reward you would be willing to get from an interest rate perspective for just keeping that money there. But if you have a sort of medium term of what you want to do with that cash, I wouldn't suggest a money market fund. But if you were looking at a 12 to 24 months, maybe stretching it to 36 months, then you could park the money in a money market fund. And that would give you the capital preservation, which is really protecting the money from, I wouldn't say loss in a way, but just protecting the money that you have saved up, but also giving you the reward into that saving. And that would be in the form of the interest rate that you would be able to earn by saving for that amount.
Okay, so let's. I think it's important for at this point to leave the people who are listening with, a crisp message in terms of outcomes from a money market fund. So the first one we spoke about is capital preservation. In other words, if you're concerned about losing money with the crazy markets that we have that are going up and down, you want a place to park. I know it's a fallacy that you cannot. There's no risk at all.
Yeah.
All investments have risk. I think let's be clear. But in the money market fund, it's your least risky. That's.
They're well diversified.
They're well diversified, and it's the least risky investment that you'll ever get. So capital preservation. But as a result of that, not a lot of appreciation or returns.
Yes.
So what are the typical returns that we've been seeing from money markets? And let's talk about the fact that interest rates have gone up right now and what that means to investors. I know it's painful for people who are paying debt,
Yes.
Whether a car, whether a house, but what does it mean for those who've invested in money markets? Let's talk about that.
So the financial ecosystem is all linked. So the interest rates that you can get on money market are linked to the repo rate, which is the rate that the central bank or the South African Reserve Bank sets, and that tends to be a base rate. So the higher those rates, the better interest rates you can get. And we're currently in an environment where money market funds are giving you very good rates on a one-year view or a one-year interest. But you do get periods of time where interest rates are very low and money market funds give you very low interest rates. And then across the different vehicles, you obviously get a different range of rates as well. The money market funds often all tend to give you quite similar interest rates, but they tend to give you better interest rates than just putting cash in a bank account or a 32-day deposit, that type of thing. So they're probably the best yielding vehicle for a money market or cash type investment. But the interest rates are linked to the economy, and also importantly, less relevant, but it's important to know, is that they don't guarantee that they'll beat inflation. At the moment, they're giving you returns that are better than inflation, which is good, but they can give you yields of less than inflation, which actually erodes your money in what we call real terms.
In fact, not long ago, money markets were given 5%, which was below inflation. Yeah. So absolutely. So that's the point. The point is for the liquidity, you're foregoing returns, and your money may be growing at less than inflation. So in real terms, actually, the value of your money has gone down.
And I think that speaks to the point that we've made earlier. It is an investment. So the fund managers that are looking at these investments have to have a view in terms of where interest rates are, and based on that, where we've seen interest rates being low, as what you've mentioned at 5%, they also had to see where the interest rate would be in the next 12 to 24 months, because it would essentially be a promise that you are paid on your money market fund, So I think that also speaks to not necessarily the riskiness of the money market fund, but in terms of how do you get the yield? Because if you're getting anything outside the repo rate, is there additional risk you're taking on your money market fund? And whereas the thinking is it should be a low volatile, meaning less riskier investment, but it's still exposed to the markets through the instruments. And when we say instruments, we're talking about the investments that those fund managers would be purchasing at that particular time.
Okay. So we've set the scene.
Yes.
Let's go to the second point, and this is around fees. So we've established with money markets as capital preservation, you're not going to make a lot of money. Very often if you keep up with inflation, you're very, very lucky. Hence why fees matter. Why fees matter in money market. It's the one investment where I feel I would make a decision. It's one of the critical things I would do is make a decision based on fees in terms of which provider I look at. So let's talk about fees. What are we seeing in the money market space in terms of fees?
There's a wide range of fees, what we're seeing.
Yeah.
Some are exceptionally high and some are fair value. I don't think we're seeing fees that are incredibly attractive. I think that's what's missing.
Yeah.
And fees are important because, one, these are not high returning investments. They're low returning investments. So the larger the fees, the more they come off the investor's value. And fees come off the bottom line. So they really matter a lot. Fees is driven by competition. So if there's more competition, the fee should be competitive. We also don't see that though. So there are forces that are that should be driving more competition.
Yeah.
And I think it's around what we're trying to do here today is knowledge and education.
And exactly, that is, so the whole thing around treating customers fairly, one of them was around transparency in terms of how fees are being charged. Mmathabo, I think you would agree with me. In the institutional space, as opposed to the retail investors, we have boards of trustees that are able to, and we have economic muscle. So we can negotiate fees. But I think the difference in the retail space is you're dealing with individuals. So very often they don't know what questions to ask when they're engaging with you in terms of fees. They don't know when you tell them the fees, whether it sounds right or not. Absolutely nothing. And there isn't any regulation of money market fees. So my sense is people or service providers who are charging people, it's free for all. Whatever I can charge, it now just depends on my either pricing philosophy or my stance on treating customers fairly, or it's simply, I see this as an area of I can make quite a lot of, is how I see it. So correct me if I'm wrong. But I think maybe let's talk about the sort of ranges that we're seeing. And then we can talk to people around what should ideally be the range. We can break it down. We'll come back and break down the fees. But I think let's talk about the ranges that we're seeing in the money market space.
I think what you were mentioning, Mabatho, in the institutional space, the ranges are really competitive for starters, and because fund managers know that institutional clients generally bring in sizable assets for them to manage, and in other instances, they can be managed on a segregated portfolio, meaning that those assets are just ring-fenced to that institutional investor. You are able to bargain in terms of fees, and they could range from anything between 10 basis points to about 30, right? But
from 10
also,
to 30, okay.
But 30 is also expensive.
It's very high, yeah.
It's very high, but it's still comfortable, and that would also depend on the type of money market fund that you are actually targeting as a pension fund and your objectives around that. So let's say on the high end, you would see about 30 basis points. And this cost also would include the other sort of behind the scenes costs that are not natural to the institutional investor, because at any given point in time, fees need to be paid, people need to be paid. So about 30, that would be high.
So that we'd talking, that's what we would call a total expense.
Yes.
Okay.
Yes.
Let's talk about, because I know you've done some analysis on the retail side in terms of, I also looked at, some fun fact sheets, but let's see what you found out in terms of what you're seeing from a pricing in the money market space.
Yeah. So firstly, the range is wide.
Yeah.
It's very wide. And I mean, we've seen some of the fees that are charging, close to 0.7% or 70 basis points.
For a money
which
market.
in the money market space is incredibly high.
Yeah.
These days you can buy equity funds,
some
passive, but even some active for, 0.5%, 50 basis points. So for a money market to be anywhere near close to an equity fund is ridiculous.
Yeah.
And then we're seeing figures down to about 0.3, 0.35.
Yeah.
Which seems quite reasonable. But I can tell you from global experience, if you look at some of the very large global providers out there in the retail space, it's not impossible to get a money market fund, globally for 0.15%, 0.2%. So I think South Africa's got some catch up to play, but within the SA environment, the fund ranges of fees are very wide.
Yeah.
But it's also not that easy to find these numbers. We know where to look.
Yeah.
And that talks to the point about there needs to be greater accessibility, transparency, so that people know where to look and then what they're looking at.
Yeah, absolutely. So I think for me, the range is high, as you say. What we've seen in the retail space from 3.35 all the way to 70 basis points. I think the question is ultimately and ideally, if things were operating fairly, where should the range be? One of the things that I expected, actually, as I was looking at the data, is that as funds become bigger, scale, that you'd see a fee reduction. But that's not what you're seeing either. Some of the biggest funds with assets over 14, 15 billion are charging some of the highest fees that we are seeing in this industry. So at what point and what range should we be getting to? Because if economies of scales is an issue, then we should actually see a fee reduction for clients. Yeah. What is that ideal scale that a money market should be? That ideal range for a money market?
I mean, I think the providers are missing a trick, some of them, in that they can use their scale to make themselves more competitive.
Yeah.
I think in some regards it's lethargy. They may be part of a large organization that has lots of products, and the money market is just one of them, and they think their other clients will just put the money in the money market fund with them because it's convenient and they can charge high fees, which is taking advantage.
Yeah.
So the range, 0.2%. I mean, is there justification for a fund to charge 0.5%? Some of the smaller organizations, newer businesses out there, very capable people, but starting up, maybe they could justify starting off with a slightly higher fee because they think they're going to grow quickly, deliver competitive returns or interest, and then be able to lower their fees. But actually, I think what you do see is what you don't see is fees being lowered.
No,
we don't see that reduction in fees.
Yeah, I'm going to say something controversial here. I think this is just an easy space to make money for people, and there's no pushback. So if there's no pushback, there is no incentive to change. There really isn't, because unlike as I was saying, no one is looking at it. Should the regulator be looking at it? Should the Seeiso, for example, be looking at it and say, regulating guys? For money markets, especially when you have scales, the range should be between so and so. Yeah. At least you're saying around about 35.
Yeah, maybe 35 to 50 maximum.
Yeah, 50 is a lot.
It's a lot.
Yeah, for a money market fund.
Yeah.
But I do want to get to talk about instances where, in some ways, for a limited period, you can live with a higher fee. And that's in instances where maybe there's a startup, as you were saying, but with the understanding that as they build scale, that the fees will be reduced. Yeah.
And I also think even with fund managers that are starting up, you would just also get a general mix between institutional investors and retail investors. So that gives some room for the fund manager to be competitive in their pricing, because with assets that are coming from the institutional investor, they might use the same systems, which would be of benefit to them in lowering their fee. But what you generally find is that with startup fund managers, they have to access other providers' platforms. That cost is nothing that they can control internally. Okay. So they are price takers there.
And that's where the difference is. In many of these big funds, there isn't a difference between what we call the TER, which is total expense ratio. So there are two things that investors need to look at when they look at information. If you're looking at a fund fact sheet, because you can actually get these online, all asset managers will have fund fact sheets. So you can actually Google whatever asset manager and get a fund fact sheet. You'll often find two things that are put there. It's the total expense ratio it's a total investment cost. So it's a total investment cost. That is a cost the asset manager managing.
Correct.
The other costs that come in, the total expense ratio, which is the total that you're going to be paying, includes the platform fees, etc., etc. Yeah.
Yes.
Okay.
So brokerage fees in terms of the financial advisors almost distributing that product to the market. So those costs are then lumped together with the fees that we are seeing. And I think that's where the discussion of do fees matter? And the answer is yes. At what stage is peeling through the layers of fees and getting a sense of what is the correct fee range for the services offered by the fund manager, but also because I'm preserving this capital so that my money is not eroded by fees. You know, I am making this investment return, which is really not really high because I'm in a low risk environment. But when it gets to my bank account, fees have been deducted. It looks as if I've put it underneath the mattress.
Yeah.
So how do you navigate that in terms of fees?
Yeah. What I've also found out, the other aspect of fees, is that aside from the expenses that we have, there is also, very often investors will also need to pay an advisor fee. Over and above that, you're paying for an advisor fee.
Yes.
The other thing that struck me when I was comparing the different fund fact sheets is that actually the difference in performance between the top performer and the bottom performer is there is such a narrow range, you know. So you cannot justify high fees on the basis of performance because the range is so narrow.
Yeah.
And in fact, high fees completely just erode any of that minor returns that you've gotten. So there isn't a justification in terms of. So the reason I think this is important for people to ask, and that's the message we're wanting to ask. You must ask how much you're being charged and negotiate, right?
Yeah.
Negotiate.
Negotiate.
You can negotiate.
Negotiate.
Always, yeah.
Negotiate.
Yeah.
And if you can't negotiate, understand you have alternatives, right?
Yes.
Yeah.
I think to what you were saying in terms of the performance, the investment objective or the purpose of a money market fund is almost spelled out when you start investing in a money market fund. You're preserving your capital. You don't want to expose it to risk, but you want to earn a return. So then in terms of the flexibility, in terms of the risk that the manager takes, it's quite limited to this accessibility, liquidity, and constraints within the objective of low risk and, let's say, low return. So based on that, you are then starting to see that fees then play a role, because any additional return that you are making in this low risk environment should enhance whatever you've put there, because you're not really going to get the capital appreciation from the investment. So then your cost structure becomes your most important structure in a money market fund. Whereas in other investment portfolios, you could say it can be offset with the investment return that I get. But in a capital preservation, you are already framing your mind to say, I need, i.e., this 100,000 in the next 12 months. So if the fees are exorbitant and you are only getting 100,000 and maybe an additional 1,000 rand, whereas you could have gotten 102,000 rand and the rest is eaten by fees, that's when it starts, becoming more important. But if you were not, it wouldn't matter. So it does matter.
Yeah, and I think one of the reasons we're having this conversation, it really is to understand if we're being consistent here as an industry and treating customers fairly when it comes to charging fees to retail investors when it comes to money market. And my conclusion is that we can do better.
Yeah.
We can do better. Mark, the message that we left the investors who are listening or people who are listening is that they need to negotiate and they need to compare. The problem is there isn't a consistency in terms of disclosure. So to make that comparison, I think there are gaps in this whole thing, in the money market surveys, in comparison. I mean, one of the things I was saying to you, the fees that I'm seeing on fund facts are very different from the fees that I saw on the
data.
On the data. So there clearly is some work to do from a consistency so that we compare apples with apples when we're looking at different providers.
Yeah.
So that, and also so that we have some sort of surveys that everybody can tap into and ensure that we are all disclosing the same thing. Where do we go from here?
There's definitely an opportunity. There are providers out there, websites that enable you to compare the different rates that the banks are offering on fixed deposits, which is not the money market. That's a different, a different type of saving. So equally like that, I think we need more surveys. As you said, there are the fund fact sheets that a investor can pull out a fund fact sheet of a provider they're looking at. But if you want to look at 10 providers, you have to pull 10 fund fact sheets. So we do need better disclosure, better ability for investors to get access to these type of numbers. So yeah, certainly an opportunity in the market for disclosure.
Yeah.
You see a lot of insurance comparison websites.
Yeah.
So that type of thing, I think that's the type of thing we need.
Okay. And also that there are surveys that are out there as well. There are like Forbes, Manager Watch on money markets, etc. Yeah, so I don't know if we've left the the people who are watching more confused, or what are we saying in terms of where do I start? Where do I go to look at a comparison?
I would also say that because as part of the cost, there's that financial advisor fee.
Yes.
Start there.
Okay.
Get somebody to walk you through what the fund fact sheet says. I mean, we are using the term now, a fund fact sheet, but the person who wants to put their money away to earn some sort of return, they don't know that there's a fund fact sheet that exists in that world and that they can use to compare anything to. So I would say, because you're already paying a cost, that you can ask more about it. Maybe start there and saying that, who are the providers of money market funds? What should I be looking at? What are they showing me? What is this whole investment strategy that they are putting on their fund fact sheet? What is this document supposed to do for me? Because the benefit of sitting on the institutional side is that you can walk the journey with a board member up until they feel comfortable in the investment that they're making. You often don't see that in the retail space.
Yeah.
What you see in the retail space is sign here and bank details.
Yeah. And the problem as well, and I think that this is the whole discussion. Sometimes, I'm not saying all the time, because there are very good advisors out there, but sometimes it's about where I get the biggest commission as an advisor. That's where I will lead you. Sometimes it's not all providers. So yes, I think it's a good thing. You ask providers, but I also think you need to keep empowering yourself.
Yep.
Whether it's looking at surveys out there, as I say, the Alexander Forbes Money Market Survey, you can also pull that off the internet just to look at performance. They actually, I believe, also have a fee survey on there. But Mark, I still feel like things need to be tightened, because sometimes I'm not sure we're comparing apples with apples.
Yeah, absolutely.
Yeah.
And often the rates that you see on these fee surveys are the worst rates. So, always trying to negotiate.
Okay.
And I think ease of access is a factor, certainly in the money market. So if somebody has a bank or has other investments, that same provider often will have a money market. So it's convenient.
Yeah.
But don't accept, fees that are too high.
Yeah.
And so if they can meet the convenience factor, the fees look reasonable. As we've said, the performance generally tends to be quite similar. Then that may be an option. But if you're not comfortable, then look elsewhere. And there's lots of information on the internet, on these fund fact sheets, for investors to just start to educate themselves. Knowledge is power.
Yeah, knowledge is power. And you can invest directly with some funds.
Yeah.
So you don't need an advisor. This is the one area, because I'm managing my costs on money markets. So this is the one area, if I can go directly and I don't have to incur any other fees, that's what I would do.
Yeah.
I don't know how much Citrix charges, but we're saying, if there are ways of doing it cheaply, do that, but also always ask. And I think maybe I'll finish off this thing by saying, what is the advice you give to people? The one or two things when they're looking at this space, what is the one or two things that we said as a takeaway?
So my takeaway would be on the fee side, interrogate the fees. Don't accept the first fee you're given. Ask for a better fee. And there are instances where the provider may say, no, there's no fees. That's not true. They will be built into the interest rate. So you'll get a lower interest rate with no fees. And that's the benefit of money market funds. The professional fund managers do not share in any of the interest. They manage it on a third-party basis and they charge fees, and you need to understand the fees. So ask questions and, just get more than one option.
More than one option. I like the sound of that. Mmathabo?
I think for me, it would be one, understand why you want to go into a money market fund, because then that allows you to ask the right questions, right? If you want to preserve your capital, then cost comes into play because you've already said, I want to preserve this money for so long. But also, don't get bogged down in the jargon. Just ask intuitive questions. If you're saying this is 30 basis points, in rand terms, what would it be? There are tools out there. You can plug in how much you're putting in, what that is in rand terms, and you can see it for yourself. You know what those fees are. If you feel that those fees are excessive, ask them the second question, which we've been talking about, negotiate, right? And that would be just you intuitively engaging with the fund, not the fund manager, but the provider, to see the better outcome for yourself. Because what I learned when I came into the industry is that investment products are sold and not bought. So somebody will sell you something based on what they've put together. You just need to say, I am interested in this, and how do I access it at a favorable rate for myself?
Thank you. I think my other thing that to leave with investors to think about, we spoke about two things to look out for when it comes to fees. Total expense ratio, in fact, that's the most important one, but also total investment costs, so you understand how much the asset manager is making in terms of fee. Always look out for those in terms of making a comparison. If you as individuals say nothing, the fees will remain high. Advocacy, noise, negotiation is what is going to help this industry become better in terms of the fees they charge to retail investors and in terms of making sure that those fees align to treating customers fairly. Let's become investors that are street smart so that we can get the outcomes we want. Thank you so much for joining me in this session, and thank you for the knowledge you've shared. Hopefully it's food for thought for those who are listening, and they'll use it to start getting better outcomes for themselves. Thanks, Mark. Thanks,
Thank you.
Mmathabo.
Thank you so much.